The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A shoulder shrug of a market's day as economic data and geopolitics are back in focus. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Caroline Hyde. We are kicking you off to the closing bell right here in the US.
Absolutely.
And let's get to check in on these markets where we stand. Because look, we've managed to shrug our shoulders and be near all-time record highs, Romaine, despite the turbulence that come from the oil markets. So shining a light on the S&P 500, up 0.75%, just but 0.1% close to that all-time record high. The NASDAQ does well as well. Crude oil, though, up 5%, coming off our highs of the day. But this is about the angst, the concerns around yet more focus on Russia, stopping any flows from certain Russian oil producers internationally. What does that mean for inflationary pressures? The bond market, it falls. I'm looking at Bitcoin, though. Risk on attitude elsewhere, Romaine, it feels like. Absolutely.
You talk about risk on. I mean, investors really looking beyond some of those disappointing earnings that we got out of Tesla and out of IBM after a rare piece of macroeconomic data suggests things overall are actually improving. A pickup in home resales last month on that ebb in mortgage rates, luring more buyers off the sideline. And remember, tomorrow brings a key data point, the first official government economic report since the shutdown began on October 1st. And of course, that's going to be the read on inflation. CPI, and here's what to expect. Economists surveyed by Bloomberg expecting 0.3% growth month to month in September's core reading, which would leave it 3.1% on an annual basis. That's well above the Fed's target. And that CPI reading could indeed spark some additional volatility, but it's likely to be offset by the prospect of easing monetary policy. In fact, JP Morgan's trading desk sees a roughly 65% chance that the S&P advances following that release, saying it would take the largest of tail risks to push the Fed to the sidelines. Now, one wrench in all that Caroline alluded to is this two-day 9% bump that we've seen in oil prices after the U.S. announcement on Russian sanctions. While that pop won't be reflected in tomorrow's CPI report, we should point out the U.S. sanctions and additional pressure by the EU on Russia's energy infrastructure maybe, Caroline, could add to some of those inflation worries.
Is that tailwind? Is that unforeseen part of the market? Look, it doesn't seem to be knocking equities off of their perch, but I am looking at what the question marks are now leaving us. India says it's nigh on impossible now to really be extricating oil from Russia. But we see how much we've been seeing imports coming from Russia into China, into India, have actually been depleting of late. We've seen it tail off a little bit for the overall amount of Russian exports. But most notably, the question mark now is, Romaine, what does China do in response? And that all-important meeting that did get solidified today for next week at the APEC summit.
All right, well, let's kick things off to the close, Caroline, with Jitania Kandhari, Deputy CIO of the Solutions and Multi-Asset Group at Morgan Stanley Investment Management. And Jitania, I do want to start off overall with the inflation picture. I mean, no one's expecting a huge spike in this report tomorrow. But there is sort of this backdrop of a 3.1% core CPI that has been a full percentage point above the Fed's preferred target rate of 2% now for what, 4 years? Do you start to worry at all about that?
I think our view on inflation is that, yes, 0.3 month on month looks reasonable. I think 2026, it remains sticky at about 3.1%. Yes, 2 is the new 3, but I think what I worry more about is the extent of the Fed cuts that are being priced by the market. So when
you think it's too much?
I think it could be on the higher end, because when in the history of U.S. markets have Fed cut rates with inflation above target? Yes, it's happened in the 1990s, but to kind of expect 5 cuts, I question that. Of course, the Fed's more focused on the employment rather than the stickiness in the inflation, and we'll have to see if anything changes there. But I would think 5 cuts is a little too much to expect.
I mean, you're not necessarily out on a limb on that. We've heard this from other folks. In fact, former New York Fed Governor Bill Dudley just wrote a column for us the other day kind of saying, look, if you look at financial conditions, I mean, there's no way you can read them as being tight right now, in his view. And based on that, he's saying that he thinks the Fed needs to maybe just slow its roll just a little bit.
Yes, I think, and also we have to keep in mind that the dollar is depreciated and there will be some pass-through to inflation in the future. There are lags with respect to the currency impact on inflation and, of course, what happens with the tariffs. So I would think that, expecting 5 cuts is a little too ambitious.
Particularly when oil's doing what it's doing? How much is, for you, that really going to be an impact on prices, or is there enough slack in the market that we can make up any sort of further pushback on Russia here?
I'm not very concerned on a runaway in oil prices. I think oil remains in the 50, 60 for some time. The overall impact of oil on the US inflation has been disinflationary. It's good for the consumer. There has been a lot of excess supply. There has been excess spare capacity. I don't think all of that has been sucked out of the system yet. And demand is up, but China is still slow. So you really need the demand-supply balance to really go in favor of more demand versus supply for a runaway in oil prices.
Okay, so let's go further on the China perspective here, because the big breaking news of the last hour or so was indeed that we are going to have a meeting between Xi and Trump on the sidelines of APEC. How important is that to you, and what sort of breakthrough could we have, if anything at all?
Breakthrough is a little bit ambitious. I think we'll have some kind of confidence-building agreement rather than a
so you're
trade
optimistic.
deal. I am. I also think that, there's a lot under the hood in terms of just the tariff and deals and agreements that US and China both need to understand. Firstly, it's, just fundamentally a country-driven tariff policy is not an effective tool. Our world is organized as sectors. So there is, I'll just give you an example. Your tariff on steel is 50%, but your tariff on Japanese cars is 15%. So in effect, you're keeping them more competitive than assembling those cars in the US by paying 50% steel tariff, because that goes as an input in the car. So I think some of this realization will dawn, and I also think there are a lot of intermediate...
We've been waiting for it to dawn for a while.
But there hasn't been the impact. We haven't seen it, at least not in the official inflation reports. I know there's a lot of anecdotal evidence. In fact, just yesterday, I had a package delivered that was coming from overseas, and the UPS guy told me I owed $95 and 43 cents on it if I wanted to get it, because that was the tariff that apparently the company wouldn't cover. If we start to see more of that, where people, whether it's consumers or maybe on the business side with, we start talking about software tariffs, I don't know exactly how that works, does that then have an impact on how you look at investing? Yeah,
I think that couple of things. China is still exporting deflation, right? So even Chinese goods overall has not seen an impact. Even 2018, when Trump imposed tariffs on China, the imported good prices from China have been negative, right?
So was your good a Chinese good?
No, it was not. It was actually from the Netherlands, of all places.
So that is definitely picking up. So I think that there is some, a distinction there to make. So eventually, yes, there will be some tariff increases, but I think what we really need to understand is there will be some absorption by exporters, some absorption by companies, and some passover into consumers.
Jitania, before we let you go, I do have to get your thoughts on earnings season. We're really getting into it, thick of it now. We had Netflix and Tesla earlier this week. We're getting Ford and Intel after the bell tonight. I know it's still relatively early in this earnings season, but did you come into this with high expectations? And based on that, what you've seen so far, have those expectations been met?
Yeah, I think we worry about the extent of the expectations that are being priced in the next few quarters. Operating EPS still expected to go up 13%, consistently over the next few quarters. So we are very watchful, and we're taking a very active approach. We are looking at things at an individual level rather than an aggregate market level to really be positioning in the portfolio. So yes, most of the earnings have been okay, but we've had some consumer, etc., kind of sectors that have not been the way we thought, given all these tariffs impact that is being felt slowly and steadily in some numbers.
Yeah, interesting times we're in. A lot of risk, but a lot of opportunity as well. And of course, Jitania, one of the best in the business out there. Jitania Kandhari, Deputy CIO of the Solutions and Asset Management Group at Morgan Stanley Investment Management, kicking us off to the close here on this Thursday afternoon. When we come back, a closer look at the financial sector. It's been the talk of the town. We're going to have the CEO of Texas Capital, Rob Holmes, and separately, Thomas Michaud, the CEO over at KBW, to talk about financial sector's footing. and whether they're seeing any cracks in credit. Caroline.
And then we shift gears, Romain. Ford's Jim Farley joins us fresh off the automaker's quarterly report out after the bell with his take on the company's results.
And from horsepower to power grids, the CEO of PG&E going to be wrapping up the company's results after the bell tonight. Stick with us. This is The Close on Bloomberg. All right, the European Union is now joining the U.S. and the U.K. in sanctioning Russia energy, moving to ban natural gas imports from 2027. This is after the U.S. slapped levies on Russia's top 2 oil producers and called off a summit between President Donald Trump and Russian President Vladimir Putin. Here to talk a little bit more about the tensions is Daniel Tannebaum, a partner at Oliver Wyman, where he heads the global anti-financial crime practice. He's also a senior fellow at the Atlantic Council. All right, Dan, you saw this coming. I am curious, though. I mean, Russia has sort of perfected the art of dodging sanctions, or getting around sanctions, I should say. Is this just going to be another one of these situations where on the surface they're not allowed to do these things, and behind the scenes they just keep doing these things?
Well, it's been less than 24 hours. Sanctions are not foolproof. What's different here is there's obviously a shadow fleet that Russia's used to move oil around, but there's also been more normal-looking purchases that China and India have made. There's already early reports that state-owned oil companies in China and India are pulling back on purchases. You saw Kuwait come out today saying if there is excess demand required, we will provide it. So looking to offset the Russian barrels that may be coming off the market. So this is a scenario that we'd hoped for quite a long time. If the president, the EU, the UK decide to really enforce these sanctions, this should make a meaningful difference over time.
Well, particularly with regards to India, you think that would make, I mean, I know Trump has said publicly that he has some sort of agreement where India over time would wean itself off of it, but do you believe that is even possible? I
mean, are they going to go to zero overnight? Absolutely not. Is this already being injected into whatever trade deal is afoot? It is. It certainly is. So looking to offset Russian oil, however they're going to replace it, but I do think they will begin to wean themselves off, just like Europe did, and Europe announced that they're going to go off LNG at the beginning of 2027. So it is possible. It's just, are these countries willing to go through the effort to do so?
And I like that you push us towards the trade talks that are kicking off in Malaysia between Scott Bessent and others tomorrow, and then it'll be Xi and Trump next week. We had a great chart at the start of the show really showing how much we have seen a pullback from both India and indeed China when it comes to Russian exports of crude. But do you think there'll be a meaningful progress with Xi on that particular front, or is it more about tech and more about rare earth metals that are the key concern?
I think the longer this war has gone on, and we're approaching the 4-year mark, I think after the president announced yesterday that the Budapest summit wasn't happening, Putin launches missiles and attacks a kindergarten. That's not really something that Xi's legacy can support for the long term. I do think there may be some give here in terms of supporting an end. Now, again, I don't think they're going to zero. This is a cheap supply of energy, and there is a pipeline that connects China and Russia, so it's not quite so straightforward. But what it sounds like is they may begin to suspend seaborne oil purchases, which is at least a start to begin to reduce revenue that Russia's using to finance the war in Ukraine.
4 years, I mean, it puts it in perspective, doesn't it? Let's just switch gears more into then what comes as of next week. Because if there is a little bit of oil bargaining, what else do you think might come out of the meeting between Xi and Trump?
I mean, that's the big question. I mean, there's been so much back and forth over the last year already, even thinking back to Trump's first term. I mean, as it relates to a broader trade deal, we've seen this is a very transactional president. Things that were generally sacrosanct from a national security standpoint here can be bargaining chips with
like
respect.
Chips.
Yeah, no pun intended. So do I think that might be part of something? I do. I mean, I hope that we hold to some of our real national security grounds that really have been agnostic of administration, but it's hard to tell. I think there will be some sort of a deal. There is a personal relationship between these two leaders. What it looks like, how it may ultimately benefit Ukraine, that is a bit of a question mark right now.
Well, we already had some comments earlier today from Zelensky speaking to reporters, basically kind of saying what we all know is that China doesn't have as much of a vested interest in seeing an end to this war that maybe other countries do. Is there a sense that with these two men at the table, Trump and Xi, the idea is that they are both going in different directions. Both countries are going in different directions. China, obviously, a little bit away from the U.S. So what effect, what leverage do we have in those talks? If it's not through sanctions, if it's not through economic might, if it's not through military force, then what?
So I've been thinking about this a lot, especially with IMF World Bank meetings last week. There's an interesting divergence. The U.S. is trying to push humanity to choose between the U.S. and China. China doesn't care. It'll allow its trading partners to trade with anyone. And given the treatment of our allies to date, I think you're seeing trade deals announced for countries to insulate themselves from the U.S. So that leverage, that desire to access the dollar might not be as desirable as it once was. I'm not sure if this administration fully gets that at this point, because sitting with leaders from South Africa, from Pakistan last week, they're not going to choose. They will not choose between the U.S. and China, which means they're not following the U.S. policy here. So I do think the leverage might not be as extreme as the administration might think.
And meanwhile, there's a great story out today. It's our Bloomberg Big Take, all about how China is making real inroads into Africa, for example, with DeepSeek trying to offer and win the AI war there. How much are you seeing that we will be bifurcated longer term when it comes into the tech stack we more broadly have worldwide?
So we've been studying this pretty closely. I mean, again, whether it's in sub-Saharan Africa, whether it's in parts of Asia Pacific, their approach for pushing investment around the world, I mean, they've been at this for decades at this point. This isn't anything new. I think it's the U.S. has woken up late to the party of maybe we should try and make similar deals, and they've kind of missed the window. This began under Biden. He sent Chris Dodd to Latin America to try and strike up deals that China had long had in the bag. So I do think we've got a bit of catch up here, but there's also a treatment of our allies that's got to be part of this. And obviously we see a unique approach by the president.
It's funny you say missed the bag. I just think back to Bush, George W. Bush, when he tried to have that whole Africa initiative. And I mean, obviously a lot of that's been dismantled. So
You're trying to say that the history doesn't repeat itself?
I'm saying we've been at this for a while, and there's a reason why we're behind.
Echoes are always there. Yeah. We thank you, Daniel Tannebaum, Oliver Wyman partner and senior fellow over at the Atlantic Council. It's always great to have him. Meanwhile, coming up, credit concerns, well, they are swirling around regional banks, but Texas Capital Bancshares CEO Rob Holmes is joining us next for an exclusive interview to gauge the risk to assess the company's earnings. The beat. This is The Close on Bloomberg. Regional bank Texas Capital exceeding investor expectations for third quarter total deposits in its earnings report yesterday after the bell. Joining us now for an exclusive interview, Texas Capital CEO Rob Holmes. So I thought we were all very worried about banks such as yours, but seemingly not. You've got total deposits beating, loans held or investment at $18 billion, and most notably provisions for credit losses well below expectations of the market.
We do. And this quarter, we marked the achievement of all the strategic goals that we set out in the third quarter of 2021. So we're really, really excited about that. We've grown ROA from 0.57% to 1.3%. And we've grown capital by 247 basis points, tangible common equity, tangible assets. So we really de-risked the bank over those 4 years, and we made it much more profitable as well.
I am curious, Rob, what you're seeing with regards to the general quality of what's been floating around out there. As you know, obviously, there's been a lot of talks about some of the credit provisions that we've seen at a couple of regional banks. Are those sort of one-off idiosyncratic events or something broader we should be paying attention to?
Well, I think it's one-off idiosyncratic events. One thing that is frustrating to high-quality banks is that people talk about regional banks as if they're one. And we learned during SVB and the regional banking crisis that they aren't one. The banks are individual management team strategies, products, services, and clients. And like our criticized and classified loans went down 41%. And so, year over year.
How are you doing that? How are you being so one-track minded about the types of loans that you take on vis-a-vis perhaps some other competitors in the market?
Well, I think it starts with client selection. I think it starts with segmentation. We have business banking, middle market banking, corporate banking. In the corporate bank, we have segmented verticals, healthcare, TMT, FIG, energy, diversified, mortgage, and others. And so I think when you have expertise on the platform and you know the client you're banking and your client selection is paramount to your strategy, that is the best risk mitigant, whether it's credit, operating risk, or market risk.
So I'm curious when we talk about growth, Robin, where you see, let me rephrase that, where you want to take Texas Capital. Do you see a broadening out of your base, or are you sort of comfortable being, I guess, narrower, for lack of a better word?
Yeah, well, I don't think we're narrow at all. I think we built the first full-service financial services firm ever headquartered in Texas. So we have debt, equity, M&A, sales and trading. Our sales and trading floor is approaching $300 billion of notional trades in a very short amount of time. It's profitable since day one. We led the largest sole managed debt deal in the country 2 years ago. We led the largest sole managed debt deal in the country last year. And our equities desk started really this quarter in kind. We started making markets and equities. So we can do anything a money center bank can do, but we're located in the best state in the country.
Rob, you're located in a state that is all in on providing energy to the next fear of a bubble, which is AI. I'm biased. I like talking about technology a lot, and I see that you've done a lot of work at the bank to make it very much a bottom-up approach when it comes to your own technology stack. But are you ever worried about being overexposed to that particular part of the market, those types of companies, and that so-called bubble?
Well, I think you asked two questions. One is this transformation was built on the back of a great tech stack that we've invested in since day one. We have a modern tech stack. 96% of our critical infrastructure is in the cloud. We're really, really excited about that. We worked 4 years on a data platform that is very, very valuable and is helping us with our own AI journey. And as it relates to energy, Texas is number one in oil and gas, but it's also number one in wind and number one in solar. And we have a great energy practice with great expertise in there. So we're not over-indexed whatsoever. We have governance of how much concentration we can have in any one sector at the bank. And as you know, Texas, no segment in Texas is greater than 9% of the GDP. And so if you just follow the different industries where we are, and we do have a national business, but Texas is where the majority of it is, for sure. It's a very broad, very diverse set of clients and opportunities, which keeps the risk mitigants well in hand.
All right, Rob, I have to leave it there. Appreciate you taking time for us on a day like today. Rob Holmes, the CEO over at Texas Capital. When we come back, we continue to count you down to the closing bells and dive deeper into what's ahead for banks with earnings in the rear view. A conversation with the CEO of KBW, Thomas Michaud. That's coming up next here on The Close. This is Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
I'm Caroline Hyde.
And we should just point out, Katie Greifeld's on assignment today. She's actually upstairs. We have a conference today going on called Bloomberg's Future of Fixed Income. It's right upstairs. Yeah, two flights upstairs.
What is the future of fixed income?
I was just up there. It's sort of bringing together people from all walks of life. I had a great conversation a little bit earlier. Tony Manella over at Eldridge Industries helped co-found that company. But there's been a lot of talk, of course, about just the state of credit quality, the state of our banking system, the state of our economy after a few scares with regards to some of the write-downs we saw at Western Alliance.
Are you talking about cockroaches?
Yeah. Well, I mean, Jamie Dimon's talking about them. I don't know. You talk to some of the private credit guys, they're saying, we're not seeing any cockroaches. I don't see any. It's
beautiful where we are.
And in all seriousness, there's this idea that what we might have seen with First Brands and Tricolor might have truly indeed been just sort of one-off, idiosyncratic type of events.
Or how much can you start to scratch beneath the surface and start to see, you see one, you see thousands.
Yeah.
And with the whole world of private credit, it's got a far less transparent than it ever used to be.
Yeah, well, we should point out that the different worlds of finance have sort of been mashing together over the last couple of years. And who better to talk to about the state of the banking sector and the future of the banking sector than KBW. Pleased to say that joining us right now is Tom Michaud. He is the CEO and president of KBW, a Stifel company. Great to have you, Tom.
Great to be with you.
There are a lot of words in that intro, but I just want to get right to it here with you here. And I do want to just start off with credit quality because that's been on the tip of everyone's tongue. And it's easy to just dismiss it and say, okay, this was either fraud or this was just such a one-off event. We don't need to be worried about it. But did you see any evidence leading into this year that maybe the due diligence and was maybe not up to snuff as it would have been in the past?
So, first of all, I don't have any evidence to suggest that.
Yeah.
The first thing to always follow when you want to think about credit quality is, has there been any excessive growth? Because over my career, that's usually an early warning sign. If you see something grow too fast, then it's the first place to look for potential stress down the road. But on the subject of credit quality, so there are two snapshots. One snapshot is for the whole industry. If you look at the whole industry, this was a very benign credit quality quarter. Our analysts were estimating about 24 basis points to loans of provisions. In a historical context, that's very light. And you could say the industry is over-earning on credit. We are still in this period where credit really hasn't been anywhere in the income statement. You would expect it to normalize. And the surprise isn't that it's normalizing. The surprise is for how long it's been near zero, okay? Now, that being said, we did have 3 notable blowups on 3 individual credits. The fact of the matter is that's typical, and banks weren't built to take zero risk. Banks have loan loss reserves, they have capital. It's to handle these things when they happen. So and then you also have to remember, the industry is starting from an amazing standpoint with record amounts of capital, record amounts of liquidity. So it's in a good position to handle this normalization.
I am curious, though. I mean, you mentioned them being in this good position. Part of that has been because of certain regulations. I mean, I know they would hate to hear that, but I mean, that's been the truth. And now we're at a stage where we're talking about at least maybe a potential easing of some of those regulations, and if not that, certainly not an increase in those regulations. How do you think that's going to
Well, first of all, I think we're getting a regulatory reset, which I think is long overdue. And the surprise isn't to where the regulation's going. The surprise with how tight and how anti-bank I think it got, to the point where it was making the banks less competitive. I like to look at mortgages.
Can I just jump in there? Like, these banks are doing really well. What makes you think they're doing less competitively? Like, there are record bonuses going to people, money increasing. Why do they need to get any more competitive?
Remember, there are 4,300 banks in the country, and about 8 of them are investment banks. So I was speaking more broadly about the broader industry. The industry is doing better, but if you look at it, let's look at the S&P 500 as a bogey here. If you go back to 1998, half of the S&P financials were banks. Today, a quarter of them are, okay? You look at Robinhood, you look at Coinbase, you look at all these non-bank competitors that are coming. You look at the Federal Reserve data, most banks have lost market share as an industry to the non-banking industry. And I applaud the Treasury Secretary for talking about this arbitrage that's happened. As an example, you look at mortgages. Going into the global financial crisis, 8 of the top 10 mortgage originators in the country were banks. Today, only 2 are. They did not forget how to make mortgages. Something happened. Well, the mortgage tax or capital tax on servicing became too high to make it economic. The number of regulators a bank has relative to Rocket Mortgage is considerable and has to be factored into it. So they effectively don't do the product that they were all founded to do. So you look at areas like that, and the Treasury Secretary gave a great speech about a week and a half ago at the Fed, where he talked about we have to find out where this arbitrage is happening and allow the banks.
But in many ways, it's sometimes a lack of innovation rather than over-regulatory environment. I mean, look, Figure comes out, they list this is multiple entrepreneurs.
Can I make a statement that I believe that you can never fact check? I think JP Morgan, so it'll be very safe for me, very safe for me. I think JP Morgan may be the best fintech company in the world. And they're a bank.
No, I was just with their head of digital today interviewing her. And
don't underestimate the big banks in technology. You ready for this? If you look at JP Morgan's last investor day, they spent $18 billion on technology. PNC, which is a really big bank, spent $14 billion on all of their expenses. So the amount of money they spend, and they're innovating, and I believe the banks are okay at it. Yeah. But here's the big key, I think, for the banking industry. Deposits and payments have been their competitive moat for 200 years, okay? Yeah. To the extent that erodes, that will have implications on the economy that I think are really important. And I think you want finance happening in a regulated world, which means you'd like to have the banks do it. Don't regulate the fintechs like banks. Right. Take some of the heat off the banks and level the playing field, and I think it'd be good for growth.
I do have to ask you sort of what all this means, though, for kind of the regional banks, basically the ones that aren't sort of the big ones that we're talking about. I mean, if, their direct lending's being eaten up to a certain extent by private credit, You obviously have the fintechs coming in, taking away some of that, and even some of the deposit base has moved into the non-traditional banking sector here. Do we need, I mean, you mentioned the 44,000 plus banks we have out there. Do we still need them?
Well, first of all, when I was hearing you talk, I'd say, for now.
Okay.
Since the rise of these non-banks, there's not been a credit cycle. And by the way, there are some great non-bank lenders. I don't want to say that the whole sector's got a problem. It doesn't. But there will be some that do well and some that don't do well. I wouldn't count the banks out quite yet. The other thing about the banks is they had an inverted yield curve. The longest inverted yield curve in 47 years ended last September. So now, that is why the banks are earning better, is they didn't have to fight an inverted yield curve. So now it's kind of coming back the bank's way a little bit. So I wouldn't count them out. But there's another really important stat here, is when we had a 100-year pandemic that we had to try to fix, the government said, let's do these payroll protection plan loans. Let's get cash into small business hands fast. When you go back and look, 55% of it went through the regional and community banks.
Yeah, they came into their own.
The big banks were unable to do it.
Well,
you need them for Main Street America.
One thing I can potentially fact check you on, but it'll take a quarter until you come back and ask us so we can talk to you again, is where's undervalued? Where should people be investing in right now, therefore, across this?
So we cover 200 bank stocks. We cover 460 financials. In the banks, we've identified our two favorite spots. The $50 to $100 billion banks. A lot of these banks are earning mid-teens returns on capital and still trade at 8 or 9 times earnings. And the market was very cautious about their ability to cross $100 billion because of the regulatory tax, so to speak. Well, I think that regulatory tax has been declining in this new environment, so they can cross hopefully more easily. So our analysts have identified those stocks. And we like the investment banking stocks because we think there's a tremendous amount of pent-up demand for our activities.
If indeed the government reopens, we get a few more IPOs.
If the SEC's open.
KBW President CEO Thomas Michaud, so nice to have you.
Great to be with you.
Now, coming up, Intel's got investors wired. Remember, some of their biggest investors also happen to be the government. Now, shares, they're surging this year, and cash is flowing fast. Question now is, can the chip maker compute an earnings beat after the bell? It's our stock of the hour. That's next. This is The Close on Bloomberg. Let's check in on Intel shares ahead of the company's earnings due out after the bell. We have been in rally mode today, up almost a percentage point. The chip maker, though, facing a pretty high earnings bar. So as if investors look beyond the bottom line following a whole wave of investments. The White House, Nvidia, SoftBank, they've caused the stock to rocket in recent months. Kunjan Sobhani is here with us, senior analyst covering semiconductors with Bloomberg Intelligence. You have a great note out ahead of this with Oscar. And I'm interested in basically how you're going to see some execution really being seen here in the numbers, not just the hopes and the prayers of some investment from some big companies.
Yeah, from the fundamentals and numbers perspective, we think they'll deliver mostly in line, possibility of a slight beat. The PC market has improved slightly, and the server CPU market continues to be strong on the back of all the AI capex investments. But we don't think most investors are going to care about these numbers unless it's a large beat. If you look at the rally over the last few months, it's all been driven on the back of the deals of the US government, the Nvidia, and the SoftBank, which is a strong long-term tailwind, but doesn't do anything really to change or address the issues that they have been having in the near term, namely the progress on 18A, how are the yields looking, how will Panther Lake board out, secondly, what's the status on an external foundry customer? Is it still like a 14A story, or will 18A deliver some new revenues?
Kunjan, I am curious about the foundry and sort of the future of that, because when we started to talk about these investments that we got earlier this year, it always seemed to be that, we don't want to talk about that just yet. Or as NVIDIA said, that's not really what we're investing in right now. Why not?
I mean, frankly, they need to prove a success point, right? So 18A is that sort of an anchor or a key driver. If they are able to prove good yields, significant scale at 18A for their own internal products, that will drive a lot of these external customers. So everyone, including investors and customers, is eyeing on that success of 18A.
Anyone care about AI PCs?
Well, they do definitely, but I mean, look at the end market, right? Right now, the sexy thing is everything is in data centers. We don't see that kind of a unit growth expectations. There could be some ASP uplifts coming. We could see slightly better than expected AIPC results, but again, that might not be enough to drive a big needle-moving driver there.
All right. Well, expectations, I guess, relatively high. Kunjan going into this report. Kunjan, Sobhani over at Bloomberg Intelligence. The shares, of course, on a 70% run just since the last earnings report 3 months ago.
They trade at 63 times future earnings.
That's high expectations, Caroline.
That's high
but
expectations.
I don't know. You know, if
much
Tesla
higher than
could,
NVIDIA.
Is it?
Yeah.
Wow. Okay. All right. Well, we're going to have a lot to talk about after the bell. We're going to, of course, break down those earnings. But before we get there, we got to get you set up here on where conditions stand right now in the financial markets and in the broader economy. That conversation up next with Jeffrey Palma over at Cohen & Steers. This is The Close on Bloomberg.
What I worry more about is the extent of the Fed cuts that are being priced by the market. So when
you think it's too much?
I think it could be on the higher end, because when in the history of US markets have Fed cut rates with inflation above target? Yes, it's happened in the 1990s, but to kind of expect 5 cuts, I question that.
And that was Jitania Kandhari over at Morgan Stanley Investment Management. She started off, kicking us off to the close 50 minutes ago. She was sitting to my right. Sitting to my left is Caroline Hyde. Normally it's Katie Greifeld. She's on assignment today. She's missing quite a day here. A lot going on in the markets and in the economy.
And if you're an NBA follower, quite a lot going on in that particular part of the market. But let's get back to our knitting. We're up 0.6% on the S&P 500. We are near another record high. Even amid the wall of worry, even about when we're considering crude oil up more than 5%, is that an inflationary headwind? The bond market thinks it is, and we sell off to the tune of 5 basis points. But risk-on mood is still there, up 2.6% when you're looking at crypto. We're still seeing stocks rallying in amidst this earnings season, and we're getting some real fundamental data points, not to mention some hopes around that meeting between Xi and Trump next week.
Yeah, and with regards to the fundamentals, of course, with the government shutdown now in its, 23rd day, I think, if I'm counting right, we've sort of been devoid of any official government data. Of course, that changes in a big way tomorrow, where they are finally going to release that delayed CPI report that was supposed to come out about a week ago. So we will get a read on what happened back in September. Jeffrey Palma joins us right now in the here and now. He's head of multi-asset solutions at Cohen & Steers to help us count you down to the closing bells. And more importantly, Jeff, I do want to kind of count down, more importantly, to that CPI report, because we got a Fed meeting in less than a week from now where they're supposed to be data dependent. And I assume they have a better read than you and I. You would hope they do. But do you think that tomorrow's report could fundamentally change anyone's outlook on what the Fed does next?
So for tomorrow, probably not very much. And for next week's meeting, not very much. Expectations are pretty clear. Markets are priced for a rate cut. There's enough signs that growth has moderated, employment has slowed down, that even if we get sort of a reading that we think is going to show a little bit of stickiness still in inflation, I think we'll probably still get that rate cut. But like the segment that you just showed, we're a little skeptical that you're going to get all 5 of those rate cuts in through 2026 the way it's being priced today.
Well, this gets to a question, though. Why do we need those rate cuts? I know the Fed keeps talking about the labor market, but so far we haven't seen a material decline in the labor market. Certainly some stagnation, but not a decline.
I think the struggle here, when, if you're the Fed or anybody else who are looking at these things, is it's sort of this this K-shaped economy, as people call it, right? Where you have CapEx really strong, fueled very much by AI and technology spending. You have higher end consumers performing very well, and everything else actually does feel a little bit sluggish. So, you have that on the one hand where the Fed feels like maybe rates are a little too high, need to pull things back a little bit. But then this other side of inflation being sticky, so they probably won't push too hard, too fast, we think.
The way in which assets have traded, and yes, you can look at record highs for the S&P 500, but in large part that's thanks to a few AI names. Have there been areas that have been unloved considering the stickiness of inflation? Are there areas that need to be catching more of a bid in this situation?
Yeah, I think there's a couple things. One is broadly, we need to see earnings growth, broaden out from the very concentrated parts of the market that have done well. But if you look at, real asset markets, which is what we focus on a lot at Cohen & Steers, they have certainly lagged this year. And I think in large part because they haven't been exposed to, entirely to the AI trade. There are certain segments that are data centers, utilities, and power generation very much positively exposed. But we think that it's the rest of this market that actually does continue to benefit as growth broadens out from where we are.
But what makes you positive that growth will broaden out?
Well, there are signs that, if you do get a little bit of, interest rate cuts as we go forward, corporate profitability is quite strong. Unemployment is still quite low. And so while hiring has been sluggish, at least income growth has held up relatively well. I don't think that means it's a booming economy, but we also don't need a booming economy. That would actually pose some interest rate risk. That could actually pose some challenges. So what I think we really want to see is stabilization, and you get some fiscal stimulus next year.
But how do you sort of factor in, I guess, we'll just call it for now rhetoric coming out of Washington? You say, oh, yeah, we don't want the booming economy. I think the guy in the White House would disagree with you, and he seems to be doing everything he can in his power to force that issue. Does that complicate how you forecast things, particularly given that we know one way or another there's going to be a change at the top of the Fed by the middle of next year?
It's definitely challenging for, I think, business owners. You hear that all the time. We know survey data have been weak, whether it's consumer confidence or in some ways even small business confidence. The tax cuts next year that happen, the stimulus that comes, even if they're not explicit tax cuts, that does help support because you get some broadening out of profitability and earnings growth. But there is this uncertainty that, the risk is that the lack of confidence, kind of weighs on spending a little bit going forward.
What about next week and any clarity or clearing up of lack of confidence if indeed US and China, that part of the anxiety dials down a bit?
That would help. I don't really think that tariff uncertainty is going away. That seems pretty clear. These things come up and down. What's pretty clear is both sides at some level are incentivized to come up with some solution. A full embargo on Chinese imports because of super high tariffs is not helpful to anybody. It would push up inflation. It would slow growth. I think it's about figuring out where things meet in the middle. Certainly over the last 6 months, it's been the case that we get just enough done at every incremental meeting to keep markets and investors fairly happy about things.
I am, though. I mean, I know that this isn't the tariffs in and of themselves, but China has been sort of the big missing piece in all this. I mean, we have agreements of agreements with most of the other major players, but not with our largest player in China. So if there is even any sort of meaningful breakthrough particularly with regards to the face-to-face between Xi and Trump, does that not potentially become a positive market catalyst?
It's definitely a positive from a sentiment standpoint. I would still keep in mind that we're still going to see some price pressures and inflation pressures still have to kind of work their way through the system. It doesn't seem that trade has ground to a halt, though. And so I think from a sentiment standpoint, though, it would suggest that, we're not at an impasse from negotiations going forward.
Jeff, great stuff. Jeffrey Palma is the head of multi-asset solutions at Cohen & Steers, helping us count you down to the closing bells with just about 3 minutes to go. Stocks off the highs of the day, Caroline Hyde, but still firmly in the green. We should point out for our viewers, we got quite a few earnings coming after the bell tonight, including from Western Union, Deckers, Newmont Mining, Ford, and of course, Intel.
And a great conversation coming up with Ford. We're going to wonder really what Intel can say to vindicate a 63 times future earnings valuation that they're currently trading at.
Can I just pick your brain on that? I mean, because you are the for those who don't know, you're the co-host of Bloomberg Tech, so you talk this almost every day here. Did they have some possibility of catching up in this sort of AI race?
I think if they vindicate that they've got some customers for the future AI chip that they might or might not build, then we'd start to see them playing some catch-up.
All right. As we can move closer to those closing bells, a full breakdown of everything just happened, and more importantly, a full breakdown of all of those earnings starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Caroline Hyde, in for Katie Greifeld today as we take you through to that closing bell with a global simulcast. It starts now. Carol Masser and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, on a day where we see stocks trying to extend to record highs, but a few things, Carol Masser, might get in the way.
Yeah, definitely. And we'll see whether or not some of the earnings that we get after the closing bell get in the other way. The more that we get, so far the earnings season has been done pretty well, but we'll see whether or not that continues as more important names continue to report.
We're also set to get some government data at 4 o'clock today.
Oh,
that seems
I
weird,
forgot
right?
about that.
Well, because of the government shutdown, we're actually going to get jobless claims. The state sends the data to the BLS. Michael McKee informed me a little earlier. So they're going to crunch some numbers, and we're actually going to see some data. So
pull out their abacuses?
Abaci?
Abaci?
I don't know. Tell me.
Figure it out.
But then you've got a lot of the ongoing narratives.
Does Carol
and
not know
headlines.
that we have calculators now? Or?
No, I'm just saying.
She's still using the TI-81.
We are talking about the U.S.
It's all about mental arithmetic, guys. Right. But I think also what's interesting is, look, with tech and others in the green, many people are just pretty hopeful on some of the meetings that are coming as well. Tomorrow we start with Scott Bessent and others in Malaysia. Yeah. We get then Xi and Trump next week.
I know there are some people kind of poo-pooing that, but I think to Caroline's point, I mean, this has been a market that, to a large extent, has been sentiment-driven all year long. So if you do see some sort of, I don't know, a détente or whatever you want to call it between the U.S. and China, or even progress, maybe that does provide another leg for the rally.
Yeah, U.S. and China, biggest two economies in the world, always important if they can figure things out.
Quite a few earnings coming after the bell, including Intel, Ford, and Deckers as we get the closing bells here in New York. The Dow Jones Industrial Average up 146 points or 0.3%. The S&P 500 up about 39 points or 0.6%. 6738 looks like where we're going to settle. It takes a while for these numbers to settle. That's going to be a few points shy of its record high. The Nasdaq Composite up 200 points on the day or 0.9%. The Russell 2000 having a phenomenal day as well, up 31 points or 1.3%. But just real quickly, Carol, I do want to point out Dow Transports, the big laggard on the day, down about 2%. And part of that is on some concerning reports that we got out of Ryder, the big trucking company.
Yeah, really important, right, in terms of things moving around the economy or not. So always important to watch. Hey, having said that, S&P 500, keeping a watch on that. In Caroline, we had 284 names gaining ground on this Thursday, 217 to the downside, 2 unchanged.
And let's have a look at, on a sector-by-sector basis, who's been on the winners and who's been on the losers. It is a sea of red, even those we managed to push on over higher. Maybe we rely on just a few single names. But I think the one that we're digging into here is that the S&P that I'm looking at? Because currently in the S&P I'm seeing up 0.6%, and energy really your outperformer. Industrials, IT as well. So just consumer staples are on the red. This is the wrong chart, I think.
Intel actually crossing the wire right now. So let's just jump right to that. The company for the most recent quarter, the third quarter, says adjusted EPS came in at 23 cents a share. Now, the street was looking for 1.2 cents, so that does look like a beat. Revenue was up about 3% year over year here. Also looks like it coming in slightly above what the street was looking for at $13.65 billion. But here's your forecast. The company says that for the fourth quarter, revenue will be in a range of $12.8 to $13.8 billion. The company also saying that it continues to see some marginal improvement here on the build-out of that data center and AI revenue business, which came in at $4.12 billion in the most recent quarter.
And I think notably, our Ed Ludlow has been speaking with the CFO of the company and really talking about how the market turned out to be stronger than they originally anticipated coming into the quarter. They're particularly thinking that areas like server build-out was better. They saw a lot of money initially, as they say, go to GPUs for AI servers, but there are a significant amount of workload that can be handled by their own CPUs. So I think there is an area of growth. And they were saying, look, we're cautious about tariffs, we're cautious about noise, but on the data center side, bit of a surprise when it comes into how much stronger it was in terms of demand.
I'm also looking for any commentary about the U.S. government investment in Intel. And certainly we did hear from the company on that in the press release. Quote, "We took meaningful steps this quarter to strengthen our balance sheet, including accelerated funding from the U.S. government and investments by NVIDIA and SoftBank Group to increase our operational flexibility and demonstrate the critical role we play in the ecosystem." This according to Intel's CFO, David Zizner.
Yeah, and then addressing AI, right? So important. AI is accelerating demand for compute and creating attractive opportunities across our portfolio. And they talk about including in their core x86 platforms. They say new efforts in other, metrics, but again, addressing some of those issues. And again, we're watching Intel in the aftermarket. I'm looking at that trade up about 3.7%.
Up about 3.7%. And it gets to this idea here that what is sort of the future? We talk about a new CEO, we talk about new investments, but it's still the same old problems. And I am curious. I mean, I look at these comments, Caroline, coming out of your co-host, Ed Ludlow here. And again, I mean, how do you articulate to investors what the long-term story is?
Yeah, about the foundry business. Who are going to be the ultimate demand base for the chips that they might or might not manufacture over in Ohio? They've got to stay committed to that particular build-out. And of course, that is why the US government had been such a signal that they are going to ensure that people come to them for their chip manufacturing. That's why we do wonder about where AMD goes for its next chips to be made, where NVIDIA eventually does, and why it's such an important and strategic investment coming from them.
We're actually seeing shares rise now in the after hours, up even more than they were earlier, just minutes ago. Of course, the call has not happened yet, but investors making their way through the press release, the commentary from Ed's interview with the CFO. Intel shares up 6% in the after hours.
Ian King out with a right through and saying, of course, okay, here, Intel giving an upbeat revenue forecast after PC demand grew, boosting optimism about a comeback attempt by the company. Company's fourth quarter sales will be $12.8 billion to $13.8, with the midpoint of that range being $13.3, just below Wall Street's estimate of $13.4 billion. And that the CFO, Dave Zinsner, saying current demand is outpacing supply, a trend we expect will persist into 2026. And the company's third quarter results exceeded its projections based on the underlying strength of our core markets. That sounds pretty upbeat. And, investors' expectations remain, are high. This stock is up 90%. And one big investor, the U.S., the number 3 investor in this company.
And that seems to be why it's riding high. It's kind of interesting, too. They also talk about the refresh cycle on PCs, and that might actually be the bridge for this company. We talked about this a little bit yesterday about Tesla and its sort of robotic, autonomous future, but it still needs that money from the here and now to sort of bridge that gap. We're going to continue to break down the results coming out of Intel. The shares up 6%, but Ford shares now moving in the opposite direction.
Yeah, and let's get to it. Let's get to the forecast, which is something that we certainly care about. The company, Ford, saying it sees $1.5 to $2 billion adjusted EBIT hit in 2025 from the Novelis fire. This is that fire that we have talked about that has certainly impacted, was it aluminum specifically? And certainly made it shut down some of their factories. Also, the company sees fiscal year adjusted EBIT of $6 billion to $6.5 billion, had seen $6.5 to $7.5. And you can see that stock right now down about 3.3% here in the aftermarket.
Hopefully these end up being more one-off types of costs here, but a lot of questions really about the longer-term strategy, particularly with some of the peel back in that EV build-out and the refocus in on some of those ICE vehicles. We should point out the company also coming out with the statement right now about some new models, starting new model production here on that Ford F-150, a conversation in just a few minutes' time that we're going to have with the CEO, Jim Farley.
And I think that it's notable, he's speaking once again directly to the administration here, that Michigan-based company is going to be creating jobs, 1,000 of them, at factories in Michigan and Kentucky. They're talking about helping boost truck production to 50,000 units next year more broadly. Yes, they've been implicated by this fire, but they're really trying to remain committed to the fact that their plant is aiming to build 45,000 additional trucks, with the remaining 5,000 to be produced at the Kentucky truck plant. So really trying to find that recovery story here out of Ford.
Ford shares down 4% in the after hours. Again, we're going to hear from Jim Farley, the CEO of the company. 4:20 Wall Street time, sitting down with Romaine and Matt Miller. The company did cut its adjusted EBIT guidance for the full year. The guidance did miss the average analyst estimates. Shares still down just about 3.6%.
Yeah, the automaker also saying planning to boost that F-150 and Super Duty truck production. We know trucks have been so important to Ford to boost the F-Series production volume by 50,000 plus in 2026, citing customer demand, recover losses from that fire. But again, a lot of questions will come on that fire. We assume one-time theme, but the longer it has had an impact, certainly the impact will carry over a little bit longer as well.
I just want to get to some other earnings real quickly, and we'll get back to Intel and Ford. Deckers, the maker of Uggs and Hoka shoes, out with their results in line for the fiscal second quarter on a net sales basis, $1.43 billion. Here's your guidance going forward. The company says for the full year, expect $5.35 billion in sales. That's a little bit light than what the street was looking for at about 5.45 on average. The company says gross margins, though, should come in a little bit higher than what the street was looking for at 56%, operating margin of 21.5%. That's your guidance for the full year. EPS adjusted, of course, as it typically is, $6.30 to $6.39, the low end of that range, right around what the street was looking for here, though you see the shares pulling back about 3%.
Meanwhile, we can look at one particular company that's spiking on the back of its numbers. Payments company, Western Union. We're seeing revenue $1.03 billion. That's just slightly ahead of expectations, but the adjusted earnings per share, they're looking strong, 47 cents. The estimate was for 43 cents, and they still see their full year operating margin of 18 to 20%. we're seeing jump about, 4.4%, as there seems to be that resilience coming from this payment company amid some of the competition coming to the market.
All right, you got payments. I got gold with Newmont Corporation shares bouncing between gains and losses in the after hours. The company out with numbers reporting adjusted earnings per share for the third quarter that beat the average analyst estimate. Adjusted earnings per share came in above estimates at $1.71. Sales of $5.52 billion that beat estimates of $5.29 billion. Shares up in the after hours just about half a percentage point.
All right, just quick check again on Intel, up about 5.6% in the aftermarket following earnings, and Ford down about 1.5%. Of course, the Ford CEO, Jim Farley, coming your way in just a moment on Bloomberg platforms, Bloomberg TV and radio. All right, that's a wrap. Bunch of earnings, folks. We'll continue to watch that trade. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Caroline and Romaine continuing there on the close. Tim and I right here on Bloomberg Business Week Daily.
And our conversation continues here on Bloomberg Television. Continued coverage of those earnings that we just got out. Ford, one of the biggest decliners in the after-hours trade. One of the biggest gainers. Surprise, it's Intel, up about 7% here after reporting adjusted sales and earnings that did come in relatively in line with estimates and some guidance that seems to be giving some people, I guess, a little bit more optimism about what the future holds for a company that a lot of people had thought had been left behind. Angelo Zino joins us right now, equity analyst over at CFRA Research. Angelo, what was your first thought?
Yeah, I thought the numbers looked pretty good, Romaine. I mean, overall, the results were a bit better than expected in terms of Q3. I think, more importantly was that Q4 guide. And, when you strip out the fact that they are getting rid of or have, sold Altera at this point in time, you back that out and essentially is in line to relatively where we were looking and the street was looking at. So I think overall, there was maybe some fear about, tariff uncertainties, as well as potential pull in demand for PCs and what have you. But overall, the Q3 numbers look good. The Q4 numbers also look solid. So I think very encouraging for investors out there.
When you look at the run up that we've seen in the shares, I mean, 60+%, I think just over the last 3 months alone. Obviously, a lot of that is tied to, I guess, a sentiment shift given the investments that have come into this company. How much further does that carry this?
I mean, that was the easy part, right? Is a lot of that news flow is really kind of what's driven the momentum here for the stock and the multiple expansion. I think at this point in time, you really need to see for you to see more momentum in the shares here and some follow through. You need to see them execute. And I think what really everybody is interested in hearing on this call is what does the strategic direction look like for foundries? Have we seen any momentum in terms of new external customers, especially with the fact that now you have the administration, NVIDIA, SoftBank, all kind of contributing here, on the capital side of things. So, I think that's kind of first and foremost. And then we also want details in terms of, what does the product pipeline look like on the AI side of things? Again, that partnership with NVIDIA was definitely, a positive sign, but there's still questions on how much momentum and how much of a contributor that is going to be to the top line and bottom line looking ahead. So a lot of questions, still to be answered from Intel here.
On the foundry side, one thing I'm curious about is, I mean, it's one thing to say, okay, we're going to, take a stab at Lip-Butan's going to take a stab at really improving this, but how do you actually lure customers right now? I mean, you have a business that's relatively insular in terms of who they're supplying to, basically supplying to themselves. Is there a sense here that there will be more trust amongst third parties to actually go to Intel, given some of the history that they've had in, I guess, under-delivering, for lack of a better word?
Well, building that trust is extremely difficult, and we've learned that in the foundry side, right? And Intel's tried to do this for a couple of years now. The hope is, they've made enough effort here now moving to 18A. If they can scale 18A successfully, demonstrate the yields, even if it's just on internal products here, hopefully that builds some confidence out there from some of those external customers to at least start giving some, what I would call token business. But again, to get, some significant scale, it's going to take time. It's going to take many years before you really build that trust from at least large scale customers out there. If you really wanted to see some immediate results from the foundry side, I mean, you could see if we were to see some sort of turmoil on a geopolitical side of things, I think that would also help draw some business into Intel. But barring that, it's going to just take a lot of time.
are they going to have the money to do this? I mean, I know they've gotten some investments, but when you look at how other companies that are involved, whether it's the hyperscalers or others who are building out their AI capabilities, their AI infrastructure, their power needs, et cetera, we've seen how much cash that takes. A lot of them already had that cash at hand. Intel does not necessarily have it. Decent cash flow growth, but growth that has been slowing. Where's that money going to come from? Do they have to go back to markets?
Well, I mean, they have just gotten, a good amount of cash injection here. I mean, they are trying to be a bit more efficient. They talked about it on the last earnings call in terms of how they plan to leverage their cash usage. I mean, they are going to reduce the capital intensity levels here going into 2026 and beyond. And I think most importantly, something they did highlight on the call is, hey, listen, we're not going to significantly build out 14A development unless we start seeing some interest from external customers out there. So, 14A is going to be more of a 2027, late 2027 ramp at the earliest. So they've got time here over the next 2 years to really demonstrate some success and build realize some sort of external customers before they have, they can really start worry about ramping 14A. But nonetheless, I mean, you make a valid point. Cash is, a concern, and something here, that we're definitely going to be focusing on is, on the cost side of things, can they get to at least kind of an operating break-even level for that foundry business for 2027? Because that's going to be key.
I'm curious, Angelo, about your thoughts, just more broadly, not just with Intel, about what's been going on in the chip sector as it directly relates to the AI infrastructure build out. Obviously, a lot of talk about whether we're spending too much. Some people saying we're not spending enough on all this. At some point, we know there's got to be some sort of a plateau, if you will, in all this. And I am curious if you think that's going to come sooner than later.
I think nobody really has the answer to that question, right? But the way I would look at this right now is we've got an insatiable amount of demand at this point in time. When we actually look at the demand trajectory, it continues to be very strong, supply constrained in many respects. So as we kind of look ahead here into 2026, we do think spending will continue to be aggressive. You look at a company like Meta already highlighting the fact that they're going to spend $30 billion more next year relative to this year. So you're looking at their capex spend going towards $100 billion. We think the hyperscalers, that is sustainable. I think what gets more, I think where the questions really kind of come up is the sustainability of some of the broadening out trade in terms of the open AIs and others of the world. And I think at this point in time, as far as looking into 2026, and I'd say even to a good chunk of 2027, we do think this is a market that's going to be relatively capacity constrained, where those investments are going to continue. I think to see further momentum from that, you do need to see new use cases for AI, whether it be some of the discussions we've just heard this week on the autonomous driving side of things. I think that is going to be really important to see whether or not this momentum has legs further than, let's call it, 2027.
All right, Angelo, we'll let you get back to it. Angelo Zino, equity analyst over at CFRA. And just a reminder, the conference call on Intel starts at the top of the hour. We are keeping an eye on some other developments going on out there, particularly in the consumer space, this involving Target. According to a memo that Bloomberg News has obtained, the company on the corporate level is going to go through a bit of restructuring, laying off about 8% of its corporate employees, the first major restructuring at the retailer in years, a move that the memo seems to suggest is to cut costs and, quote, reduce complexity. This, of course, as a retailer looks to rejuvenate growth under its new chief executive officer. We should point out that 8% number that we are talking about here, that's going to represent about 1,800 roles at the corporate level. The shares have been oscillating between gains and losses in the after-hours trade. Real quickly, another earnings report crossing the wire as well, also in the consumer space. This involves Boston Beer, of course, the maker of Sam Adams, a company that's been struggling a little bit with shifts in consumption habits, as well as some of the immigration issues. 3Q EPS did come in, big growth there, $4.25, up from $2.86 in the prior year. It looks like, though, a slightly less than what the street was looking for. Revenue coming in at $537 million and change, also slightly less than what the street was looking for. And the company guiding for the year, full year EPS of $7.80 to $9.80, a bit of a narrowing of the previous range that it had given of $8 to $10.50. $1.50. All right, we do want to turn back to actually one of the more notable gainers here in the after-hours trade, and that actually involves Ford. That company just out with its earnings moments ago. Bloomberg Gabrielle Coppola joining us right now, who covers autos for us here at Bloomberg. And actually, the share is now moving to unchanged as we move forward here. The numbers overall weren't bad, but I have obviously a lot of questions, Gabrielle, about the guidance and sort of what type of guidance that they can provide that would actually placate investors.
Well, it sounds like, I mean, I think the CFO even said this in her remarks that if not for this fire at this aluminum plant in upstate New York last month, they would have raised guidance for the year. You know, the street was very impressed with GM's results earlier this week. They raised their guidance. There's other good things. You know, the auto industry got a serious break on tariffs that came out. That news came out from the White House last week. That's going to help Ford a lot. But, you know, they have tariffs are weighing on them. They've still got to deal with that. But this fire. But the underlying trend is that, you know, we're in this period of deregulation. They're going to crank up production of their most profitable, like Super Duty F-150 trucks for make up for the production that's been lost because of the aluminum fire. So I think maybe people are looking at those underlying sales trends. They had, you know, great $50 billion revenue. Their sales were good in the third quarter. You know, maybe investors are looking at that and saying, okay, this aluminum fire messed up your earnings, but there's some good things. There's some good news in here, too.
Gabrielle Coppola, who covers this for us at Bloomberg. And just to reiterate those numbers, revenue in the most recent quarter of roughly about $50 billion, up 9.3%. Ford Blue revenue rising 6.9% above estimates. Ford Model E revenue coming in 50% higher, slightly above street estimates. And Ford Pro revenue up 11% at $17.4 billion, slightly above street estimates. Pleased to say, joining me right now here in Studio 2 is Matt Miller. He is the co-host of Bloomberg's Open Interest, bringing us here on the close an exclusive conversation with the CEO of Ford, Jim Farley.
Romaine, thanks very much. And Jim, thanks so much for joining us. You had, as Sherry House was telling us earlier, you would have raised your full year guidance were it not for this aluminum plant Novelis fire. How deep was the damage? Can you quantify that in terms of like F-150 units or Expedition and Navigator units? How hard did it hit you, or will it hit you in the fourth quarter?
Well, we're still working through it, Matt. Hi, thanks for having me on the show. We're still working through it. It'll be, I'd say, around 100,000 units, but we still have the opportunity to improve that. This is really a retiming of wholesale. What we lose this year, we'll gain most of it back next year. Maybe $1.5 billion to $2.5 billion of EBIT this year, a little bit heavier on the cash because of how auto works. But we'll be gaining at least $1 billion, if not more, of that back next year. So it's kind of a retiming, very serious situation, but really proud of how the team dealt with it so far.
We also heard, as Gabriella Coppola just mentioned, that the headwinds from tariffs are really going to be cut in half. You had previously said you expected about $2 billion in headwinds from tariffs. Now you're looking at just $1 billion in those costs for this year. How did that happen? Is this just because of the proclamations that we got last Friday in terms of parts costs?
Yes, there was. And I have to thank Donald Trump, our president, and the administration. This is a huge benefit for America's largest auto producer. It did cut our tariffs to about $1 billion. It'll be about the same next year. This is basically a reduction of our imported parts that we make, that we have to import for our U.S. produced vehicles, finished vehicles. But they also announced a 25% tariff on imported heavy and medium-duty trucks, which is a big benefit for Ford because we make 100% of our Super Duties, our most profitable vehicle, in the U.S. We do not import it, but our competitors do. So a lot of things going on in the policy area, including the EPA, upcoming EPA decision on tailpipe emissions.
I am curious what type of conversations, Jim, that you've had with the administration on the potential for some sort of relief, if not equity, with regards to how much of your production is based here in the U.S. relative to some of your competitors, and whether they understand the potential disadvantage that would put you in if there isn't some, I guess, some sort of agreement to smooth that out.
Really good question. So Ford Ford produces 80% of what we sell in the U.S. Here in the U.S., we actually export more, so it's more like 85%. We are way ahead of our competitors, even our domestic competitors. Some of them are only importing or making about 50% in this country. So the administration, Donald Trump himself, really listened carefully to Ford as we made our way through adjusting these new tariffs. And that was a proclamation we saw last week where we would moderate our tariff. We still have a tariff net, but this is a much more reasonable level. And certainly it rewards us as the most American car company. And you can see our tariff has been cut in half, basically. Now, we still have more work to do, but we're very thankful to the administration for the adjustments they made as we made our way through all this after the bilateral trade agreements with Japan, for example.
What conversations are you having with dealers right now, Jim, particularly when it comes to consumer capacity to spend, particularly given how high that we've seen, at least just general prices across the board, not just on Fords, but overall with regards to car prices?
The number one thing on dealers' mind and consumers' minds, of course, is affordability. We make America's best-selling vehicle, the F-150, for 47 years now, and that's what's on the mind of everyone now in the U.S. We're starting to see payments go out another full year to 7 or 8 year financing. It's not in Ford's captive, but some of the third-party finance companies are starting to see more stress on repossessions. That's not the case at Ford. We tend to have the highest end customers because of our prices. But that's on everyone's mind right now and a key focus for us. In fact, our fastest turning vehicle is a Ford Maverick, an affordable hybrid pickup truck, because it's affordable.
On the other hand, Jim, I imagine those Mustang GTDs that we've all been salivating over are going to be sold out as soon as they're up for sale. And I'm seeing more and more new Raptors, even Raptor Rs, on the road. So I wonder how you're doing in terms of those higher margin, higher end products.
Well, it's been a great year, and that's one of the reasons why we're so optimistic about next year. You guys talked about it on the show. We have tariff and EPA tailwinds, but you're right. The demand for our real passion vehicles and our high-end pro vehicles, work vehicles, F-250s, 350, 450s, is really strong right now. And I think we're really in the sweet spot of new products, as you said, with Mustang and especially our off-roaders. Bronco, Raptor, Tremor, these are really popular vehicles, and they're also very profitable for Ford. We love those customers, and we're really leaning more and more into that part of our product range.
Yeah, I don't want to get too far off the beaten path, but I know you have a Raptor rally coming up this weekend. More than 700 customers going to be in Havasu, Arizona. And I know last time we talked on my podcast, Bloomberg Hot Pursuit with Hannah Elliott, you said you'd really love to win the Dakar even more than F1. How much are you leaning into that sort of high-end off-road racing business?
This is one of the pillars of our product strategy, which is to really be the Porsche of off-road. There is no such thing, and Ford has all the rights with Bronco and all the products you mentioned, Matt, for us to really own off-road, especially the performance off-road area. We're having all the Raptor people customers coming in from around the country. They're driving from even outside of the U.S. It's kind of a rally for our owners. We're just seeing incredible enthusiasm for these off-road vehicles. And we feel like Ford is best positioned to expand our lineup, to expand Bronco and Raptor even more. We're investing a lot more in this business, and I can't wait for you to see all the future product coming.
All right, Jim, you can invite me too if you want. I mean, don't just let Matt have all the fun. In all seriousness, Jim, I do just also want to circle back to the whole question about EVs and the strategy there. And do you see this as a reset of what we're going through right now with regards to EV production and, for that matter, EV demand?
It's a very dynamic market. We've been the market leader in the U.S. for a couple of years now. I think GM has now moved into second place. We came into the market 4 or 5 years ago with Lightning and Mach-E and E-Transit, and we have learned a lot. We'll update everyone on how we're adapting to these changes. But the market is clearly, changing in front of our eyes. Now, that isn't the case around the globe, though. Europe is about 18% all electric. The Chinese are really making a lot of progress in Europe. And in China, half the market is PHEV and EV. So globally, because Ford's a global competitor, this EV trend is very strong. And we believe in the U.S. that the affordable EV market is going to be robust for many years to come. That's why we're investing in our universal electric vehicle that will launch in a couple years in Louisville. It's an affordable vehicle, about $30,000. We think that's the most vibrant part of the U.S. EV market.
Can't wait to see the next gen EV truck that you make either, Jim. And yesterday I was lucky enough to sit with Mary Barra and Mark Royce when they showed their next gen EV tech. And I asked them how they can get to some sort of rare earth minerals independence. Because, no matter what you do as a business leader, you're always kind of beholden to China or trade talks, at least now. What are you doing at Ford to try and deal with that really difficult issue for U.S. producers?
It is, and I would just add not only rare earth, but obviously processed raw materials for batteries. And I would put a new one on the table now, mature node semiconductors that go into every Ford. All three of those are critical for Ford and for U.S. manufacturing. Matt, so you're spot on. Look, for rare earth, we continue to diversify our supply chain. There are some American and FTA country sources of rare earth. They're not as big yet, but we're really encouraged to see the administration's focus on this. And also, those companies are getting more resources now, and they're getting more serious. And with backing of companies like Ford, they'll be able to invest more. I believe we're on the right trend on rare earth. But on battery processed raw materials, we have not made a lot of headway. And the Nexperia shortage is a great reminder. Diodes, transistors, these are basic semiconductor components. They also are being dominated by China. And this is a crisis going on right now, actually. And we're going to have to make our way through this whole transition. But Ford, we've been around for 120 years. We never went bankrupt. We're going to figure it out.
All right, Jim, really appreciate you taking time for us on a day like today. Jim Farley, the CEO over at Ford. And our thanks to Matt Miller, the co-host of Bloomberg's Open Interest, as Ford shares flip from red into the green, up about 3% here in the after-hours trade. We continue our earnings coverage and look back at earnings that we got earlier this morning out of PG&E. Of course, this is the big power company here. The shares had been oscillating a little bit earlier as they did actually see some potential benefit here as we move forward, and maybe the idea of getting back behind some of those issues with regards to the wildfires. Pleased to say joining us right now in another exclusive conversation is the CEO of PG&E, Patti Poppe. Patti, thanks for being here on the program. Let's start off first. Let's start with the quarter that was, and we'll get a little bit into the guidance here. But when you take out some of the one-time items and everything else surrounding the wildfires and everything else, how exactly is business?
Yeah, look, business is great. Romain, great to be with you. Thanks for having me today. Look, we had a great quarter. We narrowed our guidance for full year earnings and we're biased to our midpoint of that narrowed guidance, which would be a 10% EPS growth off last year, and at least then forecast at least 9% EPS growth every year through 2030. We announced our $73 billion capital plan here a couple weeks ago. That is our capital plan through 2030 with no new equity, a dividend growth rate that's about 50% CAGR every year for the next 3 years. And at the same time, we're lowering rates for customers. We have a simple, affordable model at PG&E, and it delivers high value for customers at a lower cost.
With regards to that capital expenditure plan, the one you're referencing through 2030, I think the last update you gave was $73 billion. Of that, and you have to know, this is the question that every investor wants to know, how much of that is going to sort of be allocated or earmarked, if you will, specifically for the demands coming out of this AI infrastructure build out?
Yeah, it's only about $300 million a year for that today. We have a large transmission system. We do serve Silicon Valley. We serve the AI tech companies. Our building pace is matching their building pace. And we have further upside actually to our capital plan as their plans materialize. But we see all of the new load from AI being a rate reducer here in California. Our grid is underutilized. We're able to fully utilize that grid with that new load and lower rates for customers. So we're pretty excited about partnering with our tech customers who we serve today as their growth materializes here in California.
But with regards to some of the upgrades that you are starting to do and that you still need to do, I mean, how long does that take? I mean, when do customers actually see that actually being completed?
Yeah, we showed today on our call about 1.6 gigawatts of final engineering, of which about 95% will be online by the end of 2030. So for every gigawatt that we bring online, it's about a 1% rate reduction. But the good news is we're lowering rates. In fact, we've lowered rates 3 times in the last 15 months. We're lowering rates again in 2026. And we do that through a variety of capital investments and offsetting costs. We've implemented a lean operating system here at PG&E, and we are scrubbing out waste from our system, serving our customers better at a lower cost. And in fact, we shared today that we had the highest increase in brand trust of any U.S. utility over the last 12 months. And that is, I believe, because in the face of the national trend of increasing rates, our rates are going the opposite direction because we're transforming how we do work at PG&E.
And Patti, you think you can do that, maintain that, I should say? And I asked that more about the balance between what we've been seeing from the AI build out and their needs, and of course the traditional customers that you've served for years, for decades, really, and the idea that there is some concern that residential customers, and even for that matter, some corporate customers, feel like they may end up getting the short end of that stick.
Well, Romaine, there's no doubt it's all about pricing. You have to get the pricing right, but our tech companies are working with us to make sure that the infrastructure they need is both at a price that they can afford, but they care very much about their neighbors and their own families. And so they want to make sure that they are not a cost shift. And so rates are designed in California to not be a cost shift from industrial customers to residential. In fact, by design, our cost allocation is such that it is not a cost shift. And so that new load is net beneficial. In fact, we call it rate reducing load. That is net beneficial for customers. So we've been building new generation capacity in California. I think there's been some misunderstanding about that nationwide, that people thought we were out of power. We've actually added 20 gigawatts of capacity in the last 5 years here in California. Our California Independent System Operator forecasts that load with the California Energy Commission, and we've been building, and that building is already embedded in the customers' bills. These additional utilization, whether it's through electric vehicles, building electrification, or new compute power, or even just new buildings, new housing, et cetera, all that new load is net beneficial for customers.
Hey, Patti, before we let you go, I do have to get your thoughts here on wildfires. I mean, we're heading back into the wildfire season, the heart of it, I should say, out there in California, particularly with everything fresh on everyone's minds from what happened at the start of this year, at the end of last year. How are you preparing for this? Are you prepared for it?
Look, we are prepared every day for wildfire season. Those wildfires happened in January. I don't think we would say we have a season, but we have a readiness posture. And I will tell you that we have had the lowest ignitions this year over the years since we've been tracking, since 2015, as a result of our layers of protection, which protect customers all the way from the point of hardening our power lines. We hit a major milestone just a couple weeks ago. We buried our 1,000th mile of power lines underground. We know that's the most affordable risk reduction in our highest risk areas. In addition to sensor technology that we're deploying, we're using our smart meters to predict where there will be a fault before there is a fault, and that prevents ignitions. The last 3 years have been high fire seasons, and we've had 0 structures damaged as a result of our equipment. Our layers are working.
Patti, really appreciate you taking time for us.
Great to be with you. Thanks so much.
Patti, PG&E CEO there, as we continue our earnings coverage. And we just want to bring you an update that just crossed the Bloomberg terminal a little while ago about the AI space, about Anthropic, about Google. Anthropic has now finally confirmed that Google Cloud deal that we've been talking about for the last few weeks here on Bloomberg, saying that it will be worth billions of dollars and that Anthropic will train and serve Claude models, and they'll have access to more than a gigawatt of capacity. Google shares are up about 1% here in the after-hours trade. Meanwhile, we take a look at some of the other big after-hours movers here. We talk about Ford, which shares had been depressed, but then we just had an interview with Jim Farley. He talked about some of the relief, if you will, that he's expecting and some of the performance that he's telegraphing going forward. Those shares now at the post-bell highs here, up about 4.5% on the day. Meanwhile, to the downside, keep an eye on Deckers in the consumer space, the maker of Uggs and Hoka shoes, down about 9%. Alaska Air unchanged on the day, and we did get those results out of Newmont Mining. Newmont Mining, though, a bit of a different story given that big run-up that we saw in the shares, now down about 3% here in the after-hours trade. That's what's going on in the public markets. Let's turn our attention right now to private markets, because private credit fund managers, they've been embracing transparency in the hopes of drawing in retail investors, a sharp turn for the historically secretive industry. Now, we got a chance to hear from a few players in that space this week about the increased focus on that corner of private markets. Let's take a listen.
If the punch bowl's being taken away, only a couple people may have noticed it yet, but so far it's still partying like it's 1999 in the credit markets for the most part.
I worry about those firms that don't have a driver's license, that have decided they want to get into private credit, have no way to drive, haven't passed a test or anything, and yeah, will they have problems? They could.
This is not a private credit story. These credits were bank-led, they were bank-originated, they were bank-syndicated. So we can't really understand why there's a referendum on private credit.
Some of the big names you've heard on Bloomberg Television earlier today, and now another one joins us fresh off the stage of Bloomberg's Future of Fixed Income Conference. Christina Lee joins us, co-portfolio manager for Oaktree's U.S. private debt strategy. Great to see you, Christina.
Hi, Romaine. It's great being here.
How do you feel about all this criticism that somehow, oh, private credit got it wrong, oh, the due diligence has been off, oh, there's some systemic risk out there?
Yeah. It's funny. I think it's called the cockroach wars,
Yeah.
another way that some people have talked about it. I would say, one, I agree. There was this comment about, there's a lot of managers out there that don't have a driver's license. I think if you looked at the industry in general in private credit, you've seen that a lot of firms actually had never been through a cycle. 70% of firms out there are kind of 10 years or less. But for example, someone like an Oaktree, we've been around for 30 years. We've gone through credit cycles. And so I think transparency will help. And I also think having managers that have gone through downturns and know how to deal with underperforming credits is critical.
And Oaktree, of course, I mean, kind of the OG in this space. And you've been there for a while. It's 2009,
Yes.
more or less. So you kind of started, kind of in the middle of the financial
Exactly.
crisis. So you guys definitely had a little bit of a trial by fire there. I am curious. I mean, your focus for years has been on mezzanine debt, junior debt as well. I am curious as to whether we're seeing more interest in that now relative than maybe what we saw prior to the financial crisis?
You're seeing mezzanine is a niche product, and where we're seeing interest right now is it's a fixed rate product. And so some investors are saying, we have our direct lending, we have floating rate exposure, but where are rates likely going to go? Most likely down at this point. So mezzanine provides fixed rate and your ability to lock in those interest rates, and I think that's where our appetite is coming from.
When you look at not just credit quality, but we'll just call it economic quality. And it means your job to sort of figure out, to a certain extent, I would think, where the economy is going, to get a read on where credit is going. Does it look positive to you?
I would say, we're not macro investors at Oaktree, but I would say, we are in a longer for higher interest rate environment. And I think from that standpoint, it's twofold. One, it's great from a spread perspective in the current market with base rates higher. But also, if you started lending and doing a lot of deals when base rates were zero, you likely might have some cracks in your portfolio, and how are you managing that? I think from an Oaktree perspective, we've always been judicious. Right now, what you're seeing is private credit, it's really competitive. Leverage is going up and spreads are tightening. And so from our perspective, it's proceed with caution. You still want to deploy, but you don't want to be deploying in everything at this point.
I am curious about the liquidity in the market, particularly when negative things pop up. Like we've been talking a lot over the last few days about First Brands, Tricolor. We know who got left holding the bag. We've also learned a lot of companies, a lot of firms out there apparently did see some trouble and either avoided it, or if they were in it, they cashed in their chips, and that includes Oaktree.
Yeah, so I would say, I think from the kind of lessons learned from that is what does your upfront due diligence process look like? As a bottoms-up investor, you should be asking those questions. Are there any types of off-balance sheet financings, et cetera? So I think that those situations, again, are not necessarily endemic of the private credit market, but was it more of a due diligence miss?
How do you see just private credit evolving? I mean, we talk about, obviously Oaktree's been doing this since the start. Howard Marks gets sent out to LA and they kind of left him to his own devices and he kind of helps to create an industry. But we've seen that change now. We've seen the partnerships now between private credit and private equity, and now with the traditional big money center banks. How much further does that go?
Yeah, I think from a private credit standpoint, it's always like, I always say from a public versus private, it's always a V. It's not. I think public markets and private markets do have to both be healthy to coexist. I think from a private credit standpoint, it's a maturing industry, right? And so how do you generate alpha? I think from our perspective, it's really building a strong portfolio to generate enough kind of withdrawal and to make sure that you're not having an issue if you're going through a downturn. And so I think from our standpoint, from a direct lending standpoint, really you need scale. And the way you generate alpha is really building a really strong portfolio.
Well, I'm curious, but what do returns look like? I mean, everyone's talked about this sort of that golden age where you're getting mid to high teen returns on some of these investments. That's over. John Gray today over at Blackstone even kind of referenced that, saying that kind of golden era is behind us. I mean, what do returns look like? Are they going to be competitive with other asset classes?
I think they're still going to be competitive. Yes, are we getting S plus 600 plus on performing borrowers? No. Right? Spreads have compressed, but if you looked at the relative value between private credit versus a broadly syndicated loan, it's still about 100 to 150 basis points. And even if you were to stretch back, say, to 2019 when base rates were zero, you're still getting probably 200 to 300 basis points more.
And you use the phrase higher for longer. And I assume you mean that in reference to the sort of zero bound that we were at. But you still have a market that, at least right now, seems to be pricing in the idea that we could be below or around 3% on the Fed funds rate within about a year or so's time here. Does that change the fundamentals for you at Oaktree?
Yeah, I don't think that necessarily changes the fundamentals. I think even at 3%, it's still a good all-in yield for credit, right? I think for a long time, credit was in an environment where base rates were zero. It was kind of falling out of favor. But I think people are saying it's great fixed income, plus you're still getting comparatively great all-in yields.
Christina, this was a really great conversation and great to have you. I know you've been busy today, right off the stage there. Thank you for doing this.
Thank you so much for having me.
Absolutely. Christina Lee is co-portfolio manager for Oaktree's U.S. private debt strategy. Meanwhile, we do want to turn back to the public markets. We were talking a little bit earlier about the big downdraft in shares of Deckers. Of course, that is the maker of shoes like Uggs and, more importantly, Hoka's. And we've been talking about a lot about that over the last few weeks here on this show. The idea that the big players in the athletic apparel space have faced a lot of challenges from new upstarts out there. And now some of those big players are trying to put things back on track. Nike has a relatively new CEO, Elliott Hill. He took the helm of the world's largest sportswear company with the one-time intern helping blunt a long-time sales slump. Now, I had a chance to go out to their headquarters in Beaverton, Oregon, talk to Elliott Hill as well as some of his key deputies about the strategy that they're taking to actually put the athlete back first at Nike. Take a listen.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
Hundreds of motion picture cameras surrounding an indoor soccer pitch. Speed sensors encircling an Olympic racetrack. Electronic pressure plates embedded in a basketball court. Biometric hookups to assess a runner's gait and posture. A hermetically sealed room that mimics the brutal heat and humidity of a Tokyo summer. All told, more than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab. An evolution from the company's experimental kitchen counter roots and a nod to its future of putting the athlete first.
This is our Nike Sports Research Lab in our Innovation Center, and this is the home to dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete, right? Phil's point, we're in this amazing building where we have dreamers building the future and work with not only elite athletes, but the everyday athlete to take those insights and understanding and build not only for the elite, what you've seen being here today, but then are able to translate those innovations through every price point.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new Chief Innovation Design and Product Officer, overseeing ideas across the company's 3 units, Nike, Jordan, and Converse. They are 2 of the key players in CEO Elliott Hill's full court press to reinvigorate growth following former CEO John Donahoe's reign. Under Donahoe, it was a tenure that saw annual sales begin to drop in 2024 as demand waned for the brand's lifestyle sneakers like the Nike Dunks and as relationships with retail partners soured. Elliott Hill is now trying to plug the hole with a refocus on athletic performance.
We're going to obsess sports. I think that's been, since Elliott returned, that's been a key part of our charge as a leadership team. And we're already starting to see the fruits. You know, we spend a huge amount of time bringing athletes here. We text with Faith Kipyegon, Elliott Kipchoge, LeBron James. We bring them to our home and then we go to their homes. So the origination for ideas is always the athlete. That's at the core of everything we do. And then we start to think about how do we apply those insights broadly to the 8 billion people who we're trying to invite into sport every single day.
So when it does actually go to market, are you going to target it towards the athlete, or are you going to try to maybe just target it towards the casual wearer?
Everything that we do and the focus on performance is listening to the elite athlete and capturing that data and information to help lead this amazing innovation. So we will for sure be connecting this story exactly to our athletes, which or who helped give us those insights, who we tested with, and that will be how we determine how we tell that story going forward. So it's very much about the insights from the athletes, the data we captured, the innovation we're delivering, and helping communicate that to consumers all over the world.
The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. I even got a glimpse into the retailer's future with Project Amplify, a footwear system with lightweight motors and rechargeable cuff batteries that aims to help you move faster with less effort. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. You know, there's plenty of opportunities where technology, we have to sort of burn the candle from both ends and figure out where the best opportunity is.
The ethos though of the company, and particularly since Elliott has taken over, is put more a focus back on the athlete. I mean, what's the difference now between what you're doing in this building and say what Bowerman was doing, you know, decades ago and, you know, whatever shack he was working out of?
Honestly, today it's just a more modern, sophisticated incarnation of what Bill Berman was doing in his lab. You know, this notion of having an idea on how you might improve an athlete performance or protection, actually building it, you know, Bill Bowerman pouring into a waffle iron, modifying a shoe. That's what this building is designed to do, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka. In its latest earnings release, Nike sprinting forward, driving over 20% sales growth in the category thanks to a redesign of its 3 big running franchises, Vomero, Structure, and Pegasus. The Converse brand, however, a problem area. Sales there, they're declining 28% in the most recent quarter. Do you worry at all about some of the recent upstarts that have come into this space, particularly on the performance side, Hoka, On Running, Norda, et cetera?
We have 3 incredible brands here at the company. We have Converse, we have Jordan, and we have Nike. So I think a lot of the work that we're doing in this new multi-brand offense that we're in is making sure that we intentionally shape the 3 amazing brands that we have. That allows us to, at certain times, come together to go after an opportunity in the market, but also to be more specific about what each brand represents and the growth potential of each. I think when we think about that, I think it's true, it's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
And we look at innovation not just in product, like Phil's talked about, but how we tell our stories and how we deliver experiences in the marketplace for consumers. And when you think of some of maybe our latest, most innovative marketing concepts, I think back to the last Super Bowl, a male sport at a really important time around the world. And we told the story of So Win through our female athletes, right? We listened to their voice. We're deeply connected to where they were at that moment. And we're able to tell the story of the support of those athletes and what they are doing in the world of sport today. So I think that's one amazing example as we continue to innovate by listening to them where they are, where the world of sport is and sport culture, and then are able to deliver something like So Win.
Amy, I'll give you the last answer here. And this is really on what you want the Nike brand to be beyond what it already is today.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
And that was Amy Montaigne. She is the president of the Nike brand, and Phil McCartney, the chief innovation design and product officer. And of course, I also spoke to Matt Nurse, the chief science officer over at Nike as well. All relatively new positions for them under the tutelage of CEO Elliott Hill, who took over just about 1 year ago. Kevin McCarthy joins us right now, senior research analyst over at Neuberger Berman. And Kevin, I am curious, I know it's only been a year. Turning around a ship of this size takes longer than just 12 months. But so far, how do you grade what Elliott Hill has been trying to do?
Yeah, it's not an easy job for sure, but I think he's proven, I think, to the investment community that he's the right guy for the job. He knows exactly, what the history, what the DNA, to Amy's point, understands what this business is all about, knows how to realign, reorganize it, or, the business around sports, centering around the athlete. And he's doing a lot of the heavy lifting right now, across reengaging wholesale community, cleaning up inventories, realigning the cross-functional teams. Mm-hmm. A lot going on for sure.
I am curious. So one challenge they do have, I mean, I know we're talking about the future, and right now we're looking at a new shoe that they're going to come out with at the start of the next year. But this is also a company that's still kind of bogged down by a lot of inventory issues that cropped up under the previous CEO. How long does it take for him to get out from under that?
We should probably be out of the main three, which have had inventory issues, are the Jordans and the Dunks and the AJ1s, and we're at probably close to being there by the end of this calendar year. And in that point, it's been a challenge. It's gone on a little bit longer than we all would have liked, but they will be probably by the end of this calendar year in a good position on the inventory front.
I am curious about the partnerships on the retail side. I mean, they've made a deliberate move back in the day to do more stuff through their own channels. And I am curious, as they sort of go back to the retailers, back to the Amazons, et cetera, do you think that's going to be a net positive on them, not just in terms of sales, but also on profitability?
Part of the way they restructured these cross-functional teams was not just to drive revenue, but it was also very focused around profitability. So I think they went into these conversations eyes wide open on kind of what the opportunity was. First is they need to change the conversation. They need Nike to show the passion that they have as a business, put that back into the conversations, know that their retail partners aren't being, hung out there, that they're going to be supporting them and helping them through. So I do think this is kind of a 1 + 1 = more than 2 in this situation, by just driving greater relevance and really engaging that frontline offense, which was something that with Elliott's predecessor that wasn't being done, which was unfortunate, because that is your frontline sales team right there.
All right, Kevin, great stuff. Kevin McCarthy, senior research analyst over at Neuberger Berman, a closer look at Nike, and we still got to wait another month and a half before we get their next earnings. Meanwhile, we are getting earnings today out of big names like Ford, Intel, and Deckers. Ford continues to hold on to its gains here in the after-hours trade. Ford CEO Jim Farley just speaking with us a little while ago, talking about the supplier fire, a one-off, the tariff impact, where he sees some relief and a recommitment to the EV space. Intel, an idiosyncratic story, but investors continue to like what they see in that turnaround project, an 8% bump up in the shares. But Deckers, the footwear space, down about 10%. This could be an interesting story when it comes to the health of the consumer. We'll cover it more tomorrow right here on The Close.